All right, guys. Like always, I'd like to thank you for being here today. I'm Big Mike, and the presenter today is going to be Jack Schwager. So cover just a few basics for those of you that are new. First of all, the webinar is being recorded, and I'll post the recording on the site sometime tomorrow, maybe Monday, since it's a weekend. We already have a long list of questions that we've been gathering in a thread on the site that I'm going to be asking Jack over the course of the webinar. But you can try to type in your questions as we go. I'll take a look at them and see if any of those can be answered today. We're going to do a mix of what was on the thread and, if possible, questions that come in as we go as well. All right, so it's my great honor to have Jack Schwager here today. He is probably most well known for his series of books called Market Wizards. There are several of them, and he has a new one that was just released a few weeks ago called Hedge Fund Market Wizards. We're going to try to talk about that one today in depth. And give me just 1 minute, and I'm going to be turning things over to Jack. He has just a couple of slides to get us started, and then we're going to open up the floor to questions from BMT members, and we're going to see how many of those questions we can get answered today. So give me just 1 second, and I'll turn things over to Jack. And Jack, I'm going to load that PowerPoint as well.
Okay, one of the things that I like to do in my books and any of the talks I give is pull out some of the major lessons that I've gotten out of speaking to all these traders. And well, today's session is basically going to be a question and answer, and that's fine with me. I thought we just would start with a few basic points. These are not the most important points; they're just a few, just time permitting, but they are all important on their own. So let's begin with the first one. There is no single true path, and I always begin with this one simply because too many people out there have the wrong question in mind. They think that trading is about finding the one way that really works to make money, whether it's some Elliott wave analysis or some way of using GAN or some other specific methodology, that there's this perception there's one way, one great magic formula out there, and if you find it, you'll do great, and it's all about finding that formula. So I like to kind of give examples or contrasts between some of the traders I've interviewed. And here I would take two people from the original Market Wizard books. First one, let's talk about Jim Rogers, who was one of the more visible people that I've interviewed. For those of you, I assume most of you, if not all of you, know who Jim Rogers is, but not all of you may remember or know that Jim Rogers was actually the founder of the Quantum Fund along with George Soros, and for many years they ran that fund together. And Jim eventually went off and decided he wanted to just manage his own money, and he did that very, very well. So he's been very successful both when he was with Soros and then independently as a private investor. If you go back and read his interview with me, you'll see that all his long-term predictions at the time, and this is back about '88 when we talked, were spot on. At the time, he was talking about gold continuing to go down for another 10, 12 years, which is exactly what it did. At the time we spoke, I think the Nikkei was somewhere in the 30,000s. He talked about it going down to 10, which seemed like a preposterous prediction, but it was exactly right. And anything he basically has had a long-term forecast on, to my experience, always seemed to work out. So he's a smart guy. He's made a lot of money. Somebody worth listening to.
Right.
Now I asked him, Jim, do you ever use charts? Because I know he's pretty much a fundamentalist. And okay, I see. I got a message here that someone's having trouble hearing me. Is that more? Is it just one person or more people?
There are a few people. We got some low volume notes, so I don't know if you're able to put the microphone a little bit closer or just start yelling at us.
I don't know. You can move the screen closer. It's an Apple. The microphone is built into the screen. Is that any better? Or?
It sounds fine to me. Yeah, most people are saying sound is fine.
Okay. Anyway, so with Jim, I asked him, Jim, do you have you used charts? And he said, like he was admitting a sin and saying, well, if you mean, do I look at it to see where the market has been? Yeah. But do I believe in any of this head and shoulders mumbo jumbo? It's nice. It's all a bunch of nonsense. And he said, I never met a rich technician. And then he pauses to be cute and says, unless you count those who sell their services.
Right.
So that's his cynical take on the value of technical analysis. And I'd like to contrast him with someone like Marty Schwartz. Now, Marty, when I first interviewed him, I had the fortune that he had just had his track record audited because he was thinking of managing outside money. So he proudly showed me this 10-year track record where he had like 25% average return. And most people aren't impressed with that until I explained that 25% average return was monthly, not annually.
Wow.
And if you start, for those of you who are quants out there, and say, come on, and you do some mental math, you'll say, how come you didn't own 1/4 of the U.S. GDP, compounding at 25% a month? Well, the answer is that his father went through the Depression and was very successful in instilling in his son a great fear of something going wrong. So he would enter, and you can check this, there were trading contests were held at the time. He would enter these trading contests with $400,000 each time, and after 4 months he'd run it into over $1 million. And then he'd take the profits, he'd put it in T-bills, and start with $400,000. He kept on going back to $400,000. So he wasn't compounding it, but he still made quite a bit of money, obviously, over that period of time, making that kind of return. And he only had 2 losing months during that period. And he lost 2% once and 3% in another month. But he explained to me that those were the months his kids were born, so he was distracted. So it wasn't that he was off his game.
Right.
Anyway, that's his. Now, what is his opinion about fundamental analysis and technical analysis? Same question. And he said, well, I spent a dozen years on Wall Street as a fundamental analyst, and I lost money every year, and I got rich as a technician. So there you have like 2 absolutely, completely contrasting opinions. One very successful guy telling you that it's all fundamentals and technical analysis nonsense. The other guy telling you he tried fundamentals, lost money all the time, and he got rich as a technician. So who's right, who's wrong? Well, in a sense, they're both wrong insofar as they say the other approach can't work. Either approach can work. Hybrid approaches can work. The only time I'll quote myself, I think, in this session, but I used the line in one of my books that there are a million ways to make money in the market. Unfortunately, they're all very hard to find. But the point is that there are a lot of different ways. There is no single way.
Right.
So if people ask me, what do you recommend is the best way to trade? I tell them it's a ridiculous question. It's like you going to an optometrist and saying, give me a prescription for glasses before you check my eyes.
Right.
I can't answer that question.
Right.
Because it's so dependent on the individual.
Right.
So anyway, I like to start with that because that's such a basic point to understand. There is no single way. You've got to find your own path. Okay, next one. Flexibility. One thing you'll find in really superior traders is that they are extremely ready to change their mind and opinion. I'll give you one example from the new book, Hedge Fund Market Wizards. A trader by the name of Jamie May. Actually, I can't have any claim to making Jamie famous to the broader world because Michael Lewis beat me to it. And he's one of the characters in The Big Short, and one of the people who made a fortune by accurately seeing what was going on and positioning himself for it. So Jamie, though, we were talking about a number of different things, and he gave me, we're talking about one of his trades, how he does research and how much time they take, and he gave me this example where in 2010 he came up with this brilliant idea. He had noticed in 2010 that China, after all those years, continued the entire history, they had always been an exporter of coal. That was diminishing and diminishing, and in 2010, I believe it was, they crossed the threshold and they became a net importer. And you could see how, with the growth in China, they were going to go from a to become a very, very large importer of coal, and being a bulky item, he naturally assumed that was going to mean there was going to be a big increase in demand for shipping capacity.
Right.
So his initial idea was going long shipbuilders was the concept. But as he did more and more research, he discovered that because of the commodity boom that had started in 2008, there had actually been a tremendous excess of shipbuilding that had gone on, and there was a tremendous surplus coming on stream, and China was only going to help partially reduce that surplus, but it was still a tremendous surplus. And therefore, the trade was not going long shipbuilders, the trade was going short shipbuilders. And now he's not the type of guy who would just go short, because that's an asymmetric, left-skewed asymmetric trade. He only does right-skewed asymmetric trades, and so he did the trade by buying puts. So, but the idea was to go short, which was exactly the opposite of his original idea to go long. And the irony was that particular trade was the single best trade in 2011.
Wow.
So the best trade that the guy does in the whole year is doing the exact opposite of what he planned to do. And so I say at the end of the book, of that chapter, good traders get out of their positions when they're wrong. Great traders reverse their positions when they're wrong.
Right. That's actually a very good quote.
Next item. Okay. I like to point out there's 4 types of trades. And too many people think there's 2 types of trades: winning trades and losing trades. There's actually 4. And good trades are not necessarily winning trades, and bad trades aren't necessarily losing trades. A good trade is a trade that, if you repeated it, the same type of trade, same type of thinking, the same type of action, over and over time, it's part of a methodology that you'll make money with a reasonable control of risk, without taking undue risks to make that money. A bad trade is one where there's no justification for the trade. It's a shoot from the hip type of trade. It's a trade you have no reason to expect will necessarily make money. It may even be a trade that has a negative edge to it. So now, a good trade that wins is the natural thing that you think. But the reality is, lots of good trades will lose.
Exactly.
And no matter what your methodology is, if you have perfect discipline and stick to it and do everything according to your methodology, you will have some portion of losing trades. That's part of the process.
Right.
Does that mean those are bad trades? No. Because given all that you knew at the time, you'd have to make the same decision all over again.
Exactly.
So those are good trades. They just happen to be losing trades. On the other hand, if you're sitting there and you've got a methodology and then you're bored during the day and you say, yeah, I got a hunch here that crude's going to fall apart. I'm going to go short. And that's your whole premise on the trade. Well, if it goes down, you're just lucky. It's not that it was a good trade. If you go to Vegas and you put $1,000 on a roulette wheel bet on red, and it comes up red,
right.
That was not a good bet.
Right.
That was a bad bet. You just happened to be lucky.
And worse yet, it reinforces bad habits, right?
Yeah. So you have to distinguish in your mind the break that association people have between assuming that good trades are winning trades and bad trades are losing trades. That's not the way it works. They are separate concepts. Okay, let's go next one. All right, implementation is an important as the idea, and this is a concept that purely comes out of the most recent book. I don't think I've had it in any of the other books. Some concepts do come across multiple times in different books, but this one only came, as far as I can recall, only occurs in this most recent book. And the trader where this came up was Colin O'Shea, who runs a hedge fund in London called Comac. And we were talking about bubbles, and he had a lot of interesting things to say about bubbles. Well, and before we get to this main point here, I'll just say one of his thoughts was that the way to make money in a bubble is not by trying to short it and being smarter than everybody else. The way to make money in a bubble is by participating in a bubble, but doing so in a controlled risk way. And anyway, his idea when we had the peak of the NASDAQ and the stock market overall, in early 2000, March 2000, started breaking down. At that point, he had known that the market was very, very overdone. He knew it was a bubble. And when it finally cracked, he pretty much assumed that was it and we were going to go into a long-term bear market. Right. So that was the idea. We're going to have a long-term bear market. So did he go short NASDAQ? No. Did he buy puts in NASDAQ? Nope. Did he do anything in the stock market? No. Why? Because he explained that the stock market is, from the short side, just tends to be extremely volatile and erratic. And if you try to sell it, even if the trade is right, there's a very good chance that one of those extreme bounces will knock you out within money management. And in fact, and I really believe that most people don't realize this, if you go back and look at NASDAQ in 2000, you may be surprised to discover that in the summer of 2000, the NASDAQ had a plus 40% rebound. Now, I don't know how many of you can tolerate a plus 40% rebound. I know I can, and certainly Colin couldn't, and he knew that ahead of time. So that's the problem of trying to go short the NASDAQ. You could have been totally right, and the odds are you would have been knocked out on one of the rallies. And I think the odds are very good that would have happened. But what did he do? His reasoning was, well, if the market is topped, that means that the economy will start to weaken. If the economy weakens, interest rates are relatively high. What does that mean? Well, it means interest rates are going to go down. So what does that mean? Well, that means you should buy bonds. So his trade was not to sell NASDAQ, but to buy bonds.
Right.
And that's what he did. And the rally in bonds, or the decline in interest rates, the same thing, was very, very smooth. So he was able to profit very nicely from this idea in a way that didn't expose him to the type of risk that was inherent in the idea. And so that's where you go from this concept that implementation is as important as the idea. In fact, maybe it's even more important.
Right.
Because if you just had the idea, he very likely could have just been stopped out.
Exactly.
Okay, those are just some, like I say, points. I could have taken others, but these seem reasonable.
Right.
And,
okay.
On in, I just got to listen to your questions and wing it.
Okay. So we got a lot of questions. I know that we won't be able to answer all of them, but I'm going to just dig right in. They're not going to necessarily be in any order. So I wanted to ask you first, when did the first Market Wizards book come out? What year was it?
It came out in 1989. The book was actually, the interviews occurred in 88, and I wrote it 88 into 89, as I recall.
And how often do people, approach you and say that even though the book is old, it still has tremendous relevance today? Because I find that that's happened with me personally.
Yeah, all the time. Many hedge fund managers still give all their hires those, the first two Market Wizard books. Hopefully, they'll include this one now too,
right,
as reading material. And the reason for that is because I believe, and I can say that now because there's proof of history. I thought so. My intention when I wrote them was, well, let me back up here, and this is true. When I first wrote that first book, there was a book which many of you probably fully familiar with called Reminiscence of a Stock Operator,
right? Yep.
Which was about Jesse Livermore, written by a fellow called Edwin Lefebvre. There was a time where people thought he was a pseudonym, but Edwin Lefebvre was a real person. He wrote books. He was a journalist. I actually even spoke to his grandson, who was about 89 when I spoke to him. But in any case, he wrote this book about Livermore, that did such a good job of capturing the mind of a trader that it's been sort of a classic Bible to traders. And I read it probably about 65 years after it was written.
Right.
And it was just as relevant as it had been written yesterday.
Right.
So when I wrote Market Wizards, I didn't say, well, this is going to be as good as Reminiscences or whatever, but I said, well, that was my goal. My goal was, I'd like to write a book that 65 years from now people will still be reading.
Right. Well, I think I read that probably 10 years ago. And the first time I read it, I put it down and I was like, that's a good story. But it wasn't, I didn't really get too much out of it until I was more experienced as a trader and actually could see the wisdom in all those little stories in that book. And that's much the same as your book. The first time you read it, if you're not quite ready to really listen to what's being said, you can kind of dismiss it as just, interesting short stories. and not so much as advice on how you can improve your own trading, which is really what it is. It's a gold mine of all these little nuggets of advice. So here's another question. What interview most inspired your own personal trading?
Gee, that is a really hard one, because I've been influenced by many people. I don't even know if I can delineate one from, what influences came from what person, and there is not like one that sort of totally resonated in my mind as oh, that's me, and so forth.
Right.
I think a lot of people, when they read the books, that does happen, because I often get people, tell me, oh, what was my favorite chapter? And the one thing I do know, it's always going to be somebody different. And it's amazing.
Right.
I think if I plotted the times I had that response from people, the graph would look like not like a normal distribution or anything like that. It would look like just a constant level, or approximately constant level, with each of the bins holding a near equal number of votes. So I think it's very, very personal. Now, in my own case, because I was so close to this and I've done so many books, I really can't delineate one particular person that was the greatest influence.
Okay, fair enough. How about this? What are the top 2 or 3 common traits that exist across all the wizards that you've interviewed that you really believe was instrumental in creating their success? And this is a 2-part question. The kicker is, do you think that those personality traits can be learned by others? Or is it really kind of built into the person? Is it part of their genetic makeup that really gives them that edge or those abilities?
Yeah. Okay. Well, I don't know that this will be the only 2 or 3. Obviously, there's lots of them, but one of the most important ones is this flexibility. I mean, that comes up over and over again,
right,
in many interviews, and I think even when it doesn't come up, it's implicitly there. So I believe that is one real common. You have to, as one trader in this latest book says, you have to be able to say, I got to buy it, I got to buy it, I got to buy it, I got to sell it. And you got to just be able to switch on a dime if the facts change. You just can't have any loyalty to your position. So that flexibility is definitely one.
Okay.
Discipline, I think, is probably the word that comes up most when you ask these people what makes them different and why have they been successful, where a lot of others haven't. And I think sort of that is another major one. And I'd have to say risk control in some fashion, being endemic into the process, is another critical one. So those 3 things I think are absolutely essential. Now, there's always exceptions. There's an interview, the last interview in this book, a fellow by the name of Jimmy Baladimas. Now, if he has risk control, it's awfully hard to define exactly what it is. He seems like almost
right.
without risk control. So, he's still been very successful. I do warn people not to try the way he trades.
Well, it's interesting that the emphasis is on risk, because I think that just yesterday I posted a handful of quotes from your books. I think it was 5 or 6 quotes. Actually, it was 6 quotes, and I didn't realize it at the time when I was posting these in the thread. But someone else pointed out that 5 out of 6 of those quotes, these are like legendary quotes from everybody, they were based on risk. They all had an element of risk, built into the quote. And I think that's really fundamental, right? You really have to have a good understanding of risk, and you have to be...
I think, Mike, that it's true that most of these traders will tell you that they worry about how not to lose money
right
before they worry about how to make money.
Exactly, right. Yeah. That's what I say, rookies ask, how much can I make? And veterans ask, how much can I lose?
Yep, that's a good line.
Okay,
so one of my books, it should be. Yeah.
I don't know.
I don't recall it. I'm not saying it is.
I'm not sure. I've been saying it so long, to be honest, I can't remember if it's something that I came up with or someone else. Probably someone else. Yeah. So let me ask this: how many, when you talk to these people, do you get a sense for the time frame that they're trading? One of the questions from a member is, how small of a time frame do you think these traders are trading? And I think that's coming from a member who wants to kind of understand the relationship, to like a typical retail trader, maybe trading a 5-minute chart or an hourly chart. What's your sense for the time frames that these traders are?
Yeah, Mike, that's a good example of one of the things that people think is, the type of thing, one of many types of things that people think are important that are actually irrelevant. I mean, they're irrelevant in the broad sense. I don't mean they're irrelevant to each particular person. I mean they're irrelevant in terms of not having a correct answer. So, I've interviewed, within the group of market listeners that I've interviewed, there are people who go from being day traders to being multi-year holders or positions, literally from from trading on a scale of minutes to trading on a scale of years and everything in between. So time, the length of trade, is one of those things that is not important in the general sense. It is one of the parameters that a trader needs to define for themselves as to what feels right, what feels comfortable, and it's going to be, for some traders it might be day trading. For some, it might be picking a position, riding it for years.
Do you find that there's a mix? Is it that one person tends to, be short-term only or long-term only, or do you find that there's a mixture where, an individual trader needs to be both good?
I think people gravitate to one or the other.
Okay.
So if it's a person like Greenblatt, Joel Greenblatt, in his latest book, he's kind of a value investor, and one of his main points is that value investing works, but the only reason why it works is because sometimes it doesn't work for very long periods of time. And that fact that it doesn't work sometimes for a couple of years at a time is enough to knock most non-true believers out of the game. And so for those who really believe in the process and apply it correctly, it will work because they will stay through those periods. So there's somebody whose perspective is, hey, you better be in this for the multiple years, or else it's not going to work. And then you have quite a number of traders in the book, number traders who will take positions that are day trading almost. So it ranges.
Okay. So another question from a member: do you feel that the market dynamics have changed over the years? Are the people that you're interviewing, do you see that they're shifting the way that they trade, from say 15 years ago to today?
In some sense, markets are always the same. There's a sense in which markets are the same, but of course there are things that are changing. There are structural changes, and you have to adapt. Good example of that is someone like Ed Thorpe, who was an originator of a lot of things, one of which was he was the originator of statistical arbitrage, as far as I know. And StatArb, essentially the idea that they had very early on was they were trying a lot of different quantitative things to see what might work.
Right.
And they found that if they looked at the stocks that had gone up the most in the past week, and sold those and bought the stocks that had gone down the most in the past week, that was a good strategy, being in a market neutral sense. That was the beginning of StatArb. So that was the original concept. But eventually more people started doing that. It eventually evolved to not only be neutral at the portfolio level, but changing the strategy so they were neutral within each sector. And that worked better. But then, more people were doing that, and then they eventually evolved to defining mathematical factors that were influencing the prices of stocks. And they were finding different mathematical factors, and then they neutralized the stocks for those factors, and that worked even better. By that time, the original concept wasn't working much at all. So that's a good example of somebody taking a concept, sticking with the concept, but adapting it as necessary.
There's quite a few questions here about high frequency trading. So I'm going to ask, so do you find that over the years we've kind of transitioned from more of a fundamental trader to a technical analysis trader? Is the new category algos? Is the new category quant trading? Is this where you really have to be in order to make money, or do you still find that some of these traders are using what might be referred to as old methods, and they're not really concerned or paying much attention to all the HFTs?
Well, the algo trading is not something that you can basically do. You can't compete in that game. It's like you'd be like trying to compete against Olympic runners with 10-pound weights and each.
Right.
You got zero chance. I mean, you can't beat these guys that are trading in 1,000th of a second and have lines where they make sure that they're close enough to the exchange so how many feet away they are makes a difference.
Right. Absolutely.
You can't win that game. What the algos are basically, what they really are, I think the way to look at them are they are the modern electronic souped up version of the old floor trader, and so you always had the bid-ask spread and people taking advantage, who would take advantage of that and make a market.
Right.
Now you have the algos who are doing it at hyper speed, and they probably do it more efficiently. So I don't have any numbers on this. My sense is they as a group probably pull more money out of the market than let's say floor traders did before we had electronic trading. But it ends up, they are the current source of liquidity as they were before. But you do have this outside group that's pulling some money out of the market.
Right. Well, you said
you always had that, though.
And you said something interesting, though. So, most people in this webinar are just your typical retail traders. Okay. And I see a lot of people that are trying to create their own bots, their own algos, and they'll be the first to admit that they're not nearly anywhere close to the sophistication that you would see from institutions and such. But do you think that that those algos that are generated by a typical retail trader with maybe a modest programming experience, do they stand a chance, or is it better?
Yeah.
Okay. So
sure, because.
Go ahead.
Yeah, because the algos are just trying to make fractions of the cent. They're just making tiny amounts of profits, but doing it millions of times. You, as a retail, or I wouldn't say the retail, but as an individual investor, you have one big advantage, and that is you can choose when to participate. And if you develop an approach where you have some edge in being able to choose when to participate, you can do just fine, and the algos will not impede on your ability to profit in any way, because it's on a totally different time scale.
Okay, so changing gears, another question. Do you have any plans to write another Market Wizards book that focuses on interviews with the modern day individual discretionary trader? So after the hedge fund book, do you have plans to come back and look for discretionary traders?
Well, the majority of traders in this book are discretionary traders, so I don't make that distinction.
That's actually a very good point.
And I should clarify here, the hedge fund, the reason this is called Hedge Fund Market Wizards is a very good reason for it. And that is, there was a book that I wrote already called Market Wizards, and there was a book called New Market Wizards, Stock Market Wizards.
Right.
And sort of the one thing I and a publisher everybody agreed on, was it had to have Market Wizards in the title. But it wasn't, and it's not that easy to come up with a word or two to attach to it.
But you made a very good point there that most of these hedge funds are trading discretionarily. So, and I think a lot of people probably don't realize that, and they picture that a hedge fund automatically means they have these huge departments and labs with all these quants that are writing code. So in these interviews, I haven't had a chance to read the book yet. I'm waiting to get my copy from you. But in these interviews, do any of these people talk about the differences between, how they manage their discretionary traders versus the quants that are, in the...
There is actually one that's a very pertinent question for one of the interviews in particular, and that's Michael Platt of Bluecrest, because as a firm, the flagship strategy is Michael, as well as a number of hand-picked traders, trading a portfolio discretionarily. And then they also have Blue Trend, which is a systematic, more like a very effective trend following type of strategy, which is purely quantitative. And they also have a couple of other smaller quantitative strategies, but those are the two big ones. And so one is pure discretionary, one is pure systematic, but there are different groups of people involved in each.
Okay. So here's another question from a member that has read your newest book, and he says that he found the Baladimas interview, and I hope I'm saying that right, to be the most fascinating of all the interviews across the entire Wizard series. And he says that at one point in the interview, you seemed to almost get frustrated with his inability to adapt his style to catch more of a change in trend. And then in turn, Baladimas seemed to get almost frustrated with your frustration. So is there anything that you can add to that?
No. Okay. So most people, anybody who hasn't read the book wouldn't have any idea what the question is talking about. So let me set the context here.
Okay.
Baladimas, by the way, he's the only non-hedge fund manager in this book, and I wasn't going to, the title fit well enough, so 14 out of 15 is good enough.
Right.
And he's a prop trader. Now, Baladimas is also, sometimes a lot of people ask me, who's the best trader, who's the most aggressive trader, but if anybody asks me who's the most different trader, those I always have trouble, it's very hard to pick that.
Right.
But if anybody ever asks me who's the most different trader, or unusual trader,
right.
Well, Baladimas, that's my instantaneous answer.
Okay.
And let me tell you the first line of that chapter. The first line of that chapter is Jimmy Baladimas breaks all the rules.
Okay.
And he does. He sells into raging rallies. He doesn't necessarily have any stops in place. He takes small profits. He pyramids losers. I mean, he breaks every single rule. I mean, and incredibly, despite doing that year in, year out, he makes millions. And also incredibly, even when he's wrong on the direction of the market, he's often even doesn't lose money or sometimes even makes money. And so now, and how he does that, we'll get to the listener's question. So the way he does that is that he trades around his positions a lot.
Right.
So let's say he's short a number of stocks and the stock market's going up, and he's basically bearish in the market. So in that type of situation, if the market, let's say, opens down a bit in the morning, he'll be taking money off the table on a lot of these stocks, and when they rally back, he'll sell them back. So all during a move, he's constantly taking money off the table.
Right.
And those profits end up sort of covering up being wrong on a trade.
Gotcha.
And his style is to sell into markets he believes are overdone, where the crowd has kind of gotten too far ahead of itself.
Right.
And he sells into that, just sells into that. But he trades around the position. And eventually, almost all the time, he'll eventually be right. The market cracks. And when it has a first big crack, he'll take money, and then he'll go look for something else to do. And I said, Jimmy, you're so phenomenally good at trading around the position that you even can make money when you're wrong the trend.
Right.
And when you believe these markets are bubbles and they break, and then they break, you're almost invariably right. Those were bubbles, and now they broke it. And then they tend to go down for sometimes years. Why not continue to trade
right.
around the position in the direction of the trend instead of against the trend?
Right.
And he said something like, Jack, you're right, but it's just against his nature. And to me, it seems like so blatantly obvious. If he just did the same thing he's doing, but did it, waited for those markets to break and then traded against them, or even if he did both, but at least didn't stop trading them after the first break, he takes like the first 5-10% of the move, and then after all that difficulty in selling into the rally, will then go looking to do something else. So That's what the listener's question was about,
Right.
and that was the conversation. So to me, it seemed blatantly obvious that he could take his skills and do so much better by continuing to trade markets once those markets he thought were shorts, once they broke, not stopping trading them, but continue to trade them. And
right. So
he didn't disagree.
This almost goes back to one of the earlier questions of, is it possible to learn how to be a profitable trader, or is it almost bred into you? It sounds like with him that it's just part of his nature, right? And he was afraid to change it. Whereas other people maybe are losing money trading, and that's part of their nature. Are they able to make the change necessary to learn the habits of being a profitable trader?
Yeah, it's one of those questions that I don't have an absolute, I can't answer it with certainty. I can tell you what my inclination is. I do believe that over the years of experience in interviewing these people, that there are certain traders that just have innate skill, like Jimmy. He's so good that he can break the rules, all the rules, and still make money. He's a natural trader. I think he has some, like just some people are natural musicians. He's got some natural ability of trading. I mean, that's the reality. It's not that he's, anyway, and you can't teach that. You absolutely cannot. In fact, and I do explicitly warn people in the book, in the summary of that chapter, I use that well-worn phrase, "Don't try this at home."
Right.
You really shouldn't. I mean, so in his case, you can't learn from him, and you can't learn how to trade that way. It works for him. It's his personality.
Just who he is. Right.
Natural.
Right.
But there are people who are not naturally gifted traders, who by learning to do the right things can go from being losing traders to winning traders. Not necessarily market wizards, but at least winning traders.
Right.
And I liken that to the analogy I use is that virtually anyone can run a marathon. It's hard to do, it takes a lot of training, but if you're really dedicated and you really put in the training, almost anybody can run a marathon. But I don't care if you're the most dedicated person in the world. If you're running a 2:10 if you're a man, or say 2:30 if you're a woman, is going to be impossible for most people, because no matter how much training they do, their bodies just aren't built to run at that speed. So, and in that sense, I think there's certain people who have innate talent and the work, and they become great at whatever it's being athletes or traders or musicians.
Right.
I think it's all the same in that respect. But anybody can learn to play an instrument. They might not play for their Philharmonic, but they can play. Anybody can run a marathon. They may not run the record time, but they can run.
But you have to find the one that speaks to you, right? I mean, you can decide I'm going to trade, but whether or not you're a short-term trader or a long-term trader or swing, or you're writing strategies and bots, or if you're discretionary, that all plays down to your personality, right? So don't you believe, or has anyone else told you that it's not simple to simply find a profitable trader and try to emulate them, because you may find no success because you have two very different personalities?
Yeah, I mean, it's not that somebody told me that, but that's something I've observed over and over again, and it's one of my main points. And it's a bit like the point I began this whole session with, about everybody's got to find their own true path. So I absolutely believe that. And when people, I get, and in fact, in this book, actually, I wonder if I could. Yeah, I think I know I have it here. Yeah, I put it in the preface. I think. If I don't, or no, maybe it's in the epilogue. I'm sorry. I know it's got to be one of those two. Let's see, because it's the type of thing that people are always getting called, trying to contact me about. And, well, okay, I can't find exactly where it is, so I'm going to paraphrase it. But I get people who contact me all the time and say, hey, and some of the stories in the Market Wizard books, they go into how some of these people are hire traders, so they always say to me, can you I want to, be a trainee. I'll do anything. I'll work for nothing.
Right.
And I think it's kind of the wrong-headed way to do it. It's not a matter of finding somebody to give you their methodology on a silver platter. It's really a matter of finding the method that works for you. And I think that's really an important message.
So let's talk about money. So when you interview these traders, do you find that most of them are making what I would consider like small, consistent profits, or are they looking primarily at outliers? And it's those outliers, maybe periods of high volatility that have really generated most of their profit.
It's a function of style. So if it's somebody like a Thorpe, who he's doing stat arb or convert arb or any of the other strategies he ran, he's looking to make consistent profits. And when I say consistent, let me explain what I mean by consistent. His first fund, 19 years, 230 months, 227 out of 230 winning, 3 losing months, all less than 1%. Now that's not only consistent, it's sort of it approaches the total impossible if markets were truly efficient.
Right.
Of course, you can tell by that comment that I don't believe they are.
Right.
So that's consistent. That's smooth. That's one approach. But you have, we talked about, like one example is Jamie May. He looks for big trade opportunities, asymmetric trades. He's looking to make 10, 20, 30 times his money on a trade. And he'll take a number of small losses, and every now and then he hits a big one. So that's a very kind of very lumpy approach, but he's always controlling the risk side. So that's a very different type of approach. Again,
right.
They each found a way that works for their talent and personality.
And that plays into this next question from somebody. He says that if he recalls correctly, you were actually mentioned in Taleb's Fooled by Randomness book. And he had said that a lot of the performance, or a lot of the outstanding performance of traders, he felt was attributed to luck. And this person's writing that he also thinks that you had a similar opinion. He wanted to know if you could expand on that and what role you think luck has in trading.
Yeah, so luck is luck has a role for sure over the short run. And luck is the reason why so many people are fooled by the markets. A lot of people think the markets are an easy place to make money because they happen to start at a time. You can only do two things. You can only buy or sell, right?
Right.
So if you, let's say, start trading stocks and you're trading from the long side, and you happen to start, say, in the 90s, or even, doesn't even be the 90s, if you started to trade in 2003, during that period, and you're basically, on the buy side of things, you're going to think you're a great stockbroker.
Right.
You don't realize is all you're doing is floating a boat in a tide that is rising, and you're going up with the tide. It's nothing brilliant that you're doing. You could be in any boat and you'd still be going up with the tide.
Right.
So a lot of people think it's easier than it is because they just happen to be on the right side of the market. But if you trade for long enough, then talent will out, and you can't win by luck. You can't win by luck because all traders have slippage as a negative and some commission costs. So
right.
You have to have an edge over the long run. So I don't think traders are lucky over the long run. I think people who were, and then I mentioned the record like Thorpe's. That record, by the way, and I even, it's a little simple probability problem to work it out. You can use an analogy of coin tosses. But to get his record, and to put it in a way that people would have, the number is so large, it's 10 to such a lot high power. But the probability is let me put it this way, you'd be 1 trillion times more likely to pick a random atom out of the entire mass of the Earth. That includes the whole depth, everything, the entire mass of the whole globe. You'd be 1 trillion times more likely to pick a random atom out of that whole amount than it would be for Thorpe to have gotten his record by luck. So
right.
There are records out there that totally disprove the possibility
right.
of markets, of it being just luck.
Well, let's talk about market efficiency. So, do you believe that the longer that you trade the markets, the more likely you are to to either go broke or at least lose whatever you made.
Yes, if you have no edge. If the markets are, see, the tricky thing about market efficiency is the markets are roughly efficient in many ways, and it's very difficult to make money in the markets by any simple approaches. And there's all sorts of academic studies that show that it's difficult to make market. Most mutual fund managers lose money, and that various different approaches don't make money, and then say, see how difficult it is, and therefore the markets are efficient. By the way, that is, I'll take a little tangent here, that is a flaw in logic by assuming that the converse of something is true. So as an example, you could say that, let me see, well, anyway, I'm not thinking of a good example right off the bat. But it is a flaw to say just because it is difficult to beat markets does not mean that that markets can't be beat. The converse is not necessarily true. So, but it is difficult, and therefore, for people who don't have an edge, over time they will lose. However, if you do have an edge, it works just the other way around. Then the longer you keep at it, the more likely you are to come ahead.
Okay.
It really comes down to whether you've got a methodology that has an edge or not.
Right, and possibly whether or not you can adapt to the ever-changing marketplace. Right. So this plays into the next question. So out of all the traders that you've talked to, I'm sure some no longer trade, right? Have they given you reasons as to why they stopped trading?
Well, to be fair, I haven't really kept up with the traders that I interviewed early on, and in some cases I have maintained contact. In most cases, they still trade. The numbers, the ones that are visible because they stayed in the business, like Wall Tudor Jones or Bruce Governor, now retired, but they traded for a long time. So many of them did trade, but the ones who went out of it, didn't stay in the business, or whether they traded on their own or not, in most cases, I just don't know.
Okay. Let's talk about psychology. Let me just ask the question, where do you place psychology and the importance, in the ladder of things that are important to be a successful trader?
It's very, very important. I think my books are more about psychology than they are about trading.
I agree. I try to stay impartial because I am known to kind of lecture people about psychology, and there's always a lot of people that push back on that, saying that psychology has little or no part in trading.
It has everything to do. It has everything to do because it all comes down to the individual trader, and it's not so much the methodology. You can give a good methodology to someone who has the wrong psychology; they can lose money all the time. And and you give a poor methodology to somebody who has the right makeup, and they'll find a way to adapt it and make money.
Right.
So, I think psychology is more important.
Okay. So out of all the interviews that you've done, does everyone agree with you, or have you ever met someone that would disagree with you?
On that question?
On that question, yeah.
I can't recall it ever coming up as a source of debate or anything like that.
Okay. Probably
and again, it's not a question I've never asked. I don't think I ever asked anybody how important is psychology to trading. Basically,
it's just kind of a known thing, right?
It comes out of the answers to other questions.
Right. I agree completely, and hopefully you and I are going to be able to convert some people that don't believe. All right, so let's see. Next question. Do you think that traders have a tendency to overcomplicate the market, and that really the market is the way this guy puts it is it's a simple math base? Are markets made more complicated by traders than they really need to be?
No, I don't know. I don't think so. Markets are extraordinarily complex. Extraordinarily complex. Governor used the analogy. It's sort of like a three-dimensional chess game, is the way he put it. But you don't have. But here's the thing, okay? So the person asking the question is not wrong either. I'll give you a very specific example. The very first interview I did in the first Market Wizards book with somebody I personally knew, was a friend, That's Michael Marcus. Now, Marcus, by the way, I met Marcus because my very first job on Wall Street was a futures research analyst, a position that was being vacated by one Michael Marcus, who was going on to become a trader. And we met in that transition, and then he was still in New York for a couple of years, and we used to get together for lunch every now and then before he went off to California. And anyway, the one thing I recall, so I was at the time, I was a fundamental analyst for a number of markets, one of which was cotton. And as a cotton analyst, I went back and I researched every cotton market since the post-World War II period, did supply-demand analysis. I figured out that most of the markets were really, the prices were determined not by the market, but because of the government programs. And then I just came up with a small number of markets which were free markets, and I came with some conclusions.
Right.
And this was back in 72, 73. And based on that type of analysis, the cotton market price was about 25 cents at the time, and I thought it was a bull year, and the high had previously been about 33 cents, and I thought the market is going to go to, shall go to the old high, based on the carryover ratios and so forth. And that was right, but my thought then was if it went to the mid or high 30s, it would be kind of overdone in the sell. Now, Marcus and I, we had lunch and talked about cotton one time, and I gave him all this analysis, and he disagreed. And his thing was, China's a buyer. Now, there are a million things affecting the cotton market, but Marcus saw that the one fact that China, for the first time in history, was a buyer in the market, trumped everything else, and that was what was going to drive the market. He didn't do any analysis. He could have probably told you how many markets were free markets in the post-World War II period.
Right.
He didn't do all of this statistical stuff. All he did was look at everything and pick out that one fact that drove the market that year. And he was right and I was wrong. I mean, cotton went to 99 cents that year. And thank God I used stops because, thinking that the market's going to top out at 39 cents when the market goes to 99 is not a good thing if you don't use stops. So, I was dead wrong. I didn't lose too much money because,
Well, let's talk about stops. There's a good question here. Can you talk a little bit about the philosophy of Joe Vidich? I hope I'm saying that correctly. He talks about harvesting losses, and his expression is, stop orders are for fools. So it's not the kind of stop you're talking about, but what do you have to say?
And while he does say stop orders are for fools, and I think what he means by that is the way most people use stops is foolish or are for fools, which is namely they find an obvious point on the, let's say long a market and they pick the recent relative low and they put the stop right near the recent relative low.
Right. And
those are the points that always get taken out. So his kind of point is that using stops like that, he doesn't put it that explicitly. That's what he means. It is for fools.
Right.
But he believes in risk control, and I can say that because in 12 years of trading, he's never had a drawdown beyond single digits. So clearly, he's doing something right in risk control. What he does do is something, as you said, called harvesting losses. And it goes to the question, it goes right to the question that probably every trader faces sooner or later. And that is, if you have a conviction on a position and the market gets to a point where, the loss is getting painful, so you're faced with the dilemma, do I stop myself out, even though I still believe in the position and might rebound and whatever, or do I take the loss? And you can't make up your mind between those two.
Right.
You're worried about either getting stopping yourself out at the bottom or maybe riding a small loss into a much bigger loss. So his answer to that dilemma is, if you don't know what to do, just take some losses. Take part of the position off. And if it goes down some more, take some more. And before you know it, you're out of the position.
Right.
Steve Cohen, when I interviewed him, said exactly the same thing. He said when he's not sure, he takes half of it off, and then he'll take another half, and before you know it, the position's not that big anymore.
Right.
So that was the same concept, both interviews, and that's what he means by harvesting losses. And so if people are ever faced with this dilemma, you just don't know whether to stop yourself out or stay with the position. There are not just two choices. You can do anything in between.
Right.
You get out of half of it, 3/4, 1/4, any number you want. So I think that's a bit, and that brings to mind another so-called lesson that I have in the book, which is don't try to be 100% right. If you try to be 100% right, you'll usually end up 100% wrong. So yes, if you take off half the position, automatically we now are guaranteed you are not going to be 100% right. If it goes up, you should have stayed with it. If it goes down, you should have got out of ball. But you're half right. So like I say, people have to give up this natural human tendency of wanting to be 100% right. And if you have that type of situation, do something in between.
Or stop looking at everything as an all or nothing proposition. So talking about scaling out, what about scaling in? How many traders would you say prefer to go all in versus scaling in? And of those that scale, I am most interested in hearing if anyone's told you specifically that they only add to quote winners, or are they willing to also add when they still think that the trade is valid, but it has moved against them?
Yes. You have some traders will do the entire position at one time. Some will put on a small position and then wait for the market to go up and then build it up as it's going in their direction, assuming it's a long position. Some will say they want to, let's say, buy a market in a certain zone and will buy and then buy more as it goes down. Now, here's the very important thing about that. That is not the same as adding to losers. The key here is the decision is made before the entry. So if you say, let's say there's a stock and you want to buy it and it's 50 right now, and you think it might, you're not comfortable buying at 50, you think the market might have a pullback, you think there's going to be really good support at 40 to 45. And if you say, well, I'm going to buy a quarter at 45 and a quarter at 44 and a quarter at 43 and a quarter at 41 or whatever, and that's your approach, and that's what you do, that is not adding to losers. You just broke your size down. You just were putting on a smaller position to start because you intended to add. And that's also another example of not being 100% right, because if the market comes in and goes to 43.5, you might end up with 1/4 of your position only, and then the market goes up, but you have at least a quarter. So what you're giving up there is, for better entry, you're giving up the possibility of getting 100% position if you're right at the first point. It's a different style. Right.
Yeah, there's another trader that we've interviewed recently that he describes that as price risk versus information risk. Okay, so out of the interviews that you've done, do you know of anybody that has really almost completely changed their method, or do you find that when someone finds a method, they stick with it and they don't really make changes over the years?
I think most traders tend to stay with a similar style, although the method may change, but they tend to stay with a similar style. I don't think I can't think offhand of radical changes. Somebody like a Thorpe, the common denominator there is mathematics. His style changed a lot, completely different styles, multiple times in his career. But they were always quantitative. They were always quantitative, and they were always looking for a mathematical edge in the market. So while convertible arb is completely different than stat arb, which is completely different than mispriced warrants, they all have mathematics at the bottom of it, and that's a common denominator. So the methodology can actually change, but the underlying basics stays true to the core of the trader. So if somebody's naturally a technically oriented, discretionary trader, they might change the types of things they look at or the patterns they look at, but they're going to continue to use that type of approach.
And we touched on this briefly earlier, but there's a lot of retail traders, a lot of members that are really concerned about high-frequency trading, and they view it as the enemy. They think that these HFT bots are out there, taking out their stops and making markets, for lack of a better word, basically untradeable. What do you think about that whole picture? And let me also ask, where do you see it going in the months and years ahead?
And I kind of disagree with that. Like I say, they are pulling money out of the market, and insofar as anybody, it's like a casino. If you're playing poker, the casino's taking a part of every hand. So, sure, if the casino wasn't there, you'd do a lot better. And the fact that the casino is there means everybody has some sort of negative edge unless the skill is very high.
Right.
So that part of it is true. Okay, I don't mean to say that. But on a scale where most people trade, if they're losing money, and it's not, and the high frequency traders are not in the game of going after stops primarily. They're in the game of just scalping the market essentially.
Right.
I understand it.
Yeah.
And that doesn't necessarily, that's not a matter of gunning for stops. So I don't think that is really true. I think it has complicated the game for very short-term traders. So very short-term traders, the market action may have changed on a very short-term time scale because of their activity. So maybe that's where it might have some impact. But for most people, and certainly if you're thinking in terms of longer-term trades, and here I mean even weeks, or day or multiple days, I don't think that's that much of an issue beyond the fact that there's a third party out there taking money out of the game.
Right.
And it is a zero-sum game in some sense.
So let me ask, how do you think, or how about this? Is it harder, easier, or the same to be a successful trader today than it was like when your first book came out?
It depends. In some senses, it's more difficult for some things. For example, when my first book came out, if you were using a simple trend following method, you would have done very, very well for quite a number of years.
Right.
I think doing the same thing now, we'll still make money if it's done correctly, but not as much and with a lot more aggravation and losses involved in a much choppier path. So it's certainly that is a methodology that I think has become much, much more difficult to do, and I don't think can be done anywhere near as well as it could have been done at one time. The simple fact that there are so many computers out there and so many skilled mathematical people writing programs to beat the markets means that quantitative approaches in general are probably more difficult now because of the competition.
Right.
So in those senses, I guess it may be a bit more difficult, but you still have traders who are making money with some consistency, and I still think there's a certain percentage. I don't know, and nor do I know of any study that's ever been done on what percentage of people are successful, and I don't know if it's going down or not. I mean, it's always going to be a minority because the majority do lose.
Well, I think it's one of those things, like, I think it's common that people might say that things were not necessarily to do with trading, but just in general, things are always better, in the past, the good old days, right? Yeah. I think that a lot of people tend to romanticize how trading used to be, and now they think it's so much more difficult and so much more competitive. And I think that it's partially true, but it doesn't necessarily, mean that that's the reason that you're losing money.
Right, and even the role of the algos in this thing, while it's a negative in one sense, in a way, I think for a lot of traders, it may be better than, say, like the old NASDAQ system where if you're trading NASDAQ stocks, we had a huge bid and ask.
Right.
So, the algos are taking little slivers out of every trade. The old system, you could have driven a Mack truck between a bid and ask. Right. So I would almost argue that the current, in that sense, the liquidity of the market is better than it was. And if you trade, for example, options, and let's say options on stocks or ETFs as an example, you can go in and you can pretty much get an order. Even if you look at the open interest or volume, there may not be a lot, but you can pretty much get anything that's decent liquidity. The underlying is any decent liquidity. You can pretty much get off an option trade. You could be doing something out. You could be doing a leap in 2014, have no trouble getting it off, because there's enough for these quants out there, short-term, high-frequency traders, and the like, that will make a market. They're making a market for those things. So, right. If I want to buy an option, I'm kind of happy. I'm getting a lousy fill in a sense relative to the other side of the trade. So it's costing me 10 ticks to get the trade off, but I'm able to put on an option for a year and a half in something that I believe has a potential for a significant move, and I'm not paying that much for the option. Do I really care if I'm paying an extra 10 cents for it? So I would argue that, yeah, they make money, but it's still to my advantage because they're giving me liquidity and an ability to enter into that position that I couldn't have done if they weren't part of the market.
Okay. And so with the interviews that you just completed for your new book, do you find, I mean, you mentioned Livermore earlier in Reminiscence of a Stock Operator, and probably famous most for his tape reading abilities. How many of these fund managers would you say are using similar tools of tape reading, or maybe what's coined as order flow these days, versus your typical chart analysis?
Not that many. Not many. What I had is a couple of traders in this book that do not tape reading. Well, they do what there might be a variation of tape reading. But they pay a lot of attention to the correlation between markets, and they look for when correlations start changing. So if gold and crude are going up together, let's say as an example, for a period of time, and then crude rallies and gold goes, doesn't rally,
right,
they would see that as an indication that maybe gold's about to sell off. I'm making up an example here.
Right.
But that type of analysis is something that came up in a couple of the interviews.
That's actually
a
right.
variation of tape reading.
Right, and that's actually that's a great point. So, do you think it's possible to make money as a simple directional trader, or do you really need to be like what you just talked about, looking for divergence in multiple markets, or trading correlated or uncorrelated markets together as part of a bigger portfolio, hedging your position? Does an individual retail trader need to be more sophisticated than just a simple directional trade these days?
No, I don't think so. Again, if it's a matter of style and preference, but if an individual trader just wanted to, let's say, be a stock picker, and just try to pick stocks that he or she believes will outperform, and does the type of analysis that provides some sort of an edge,
right?
Then and uses risk management with that process, then that's fine. I don't think you need to get any more complicated than that.
Right. So, talking about hedge funds, do you think that hedge funds are something that are going to someone's saying that there's a lot of increased government scrutiny, there's more regulations. Is it harder for hedge funds to exist today? Is it harder for them to be more profitable? Or do you think that they're actually still in a growth period and we're going to see a lot more funds in the future?
Well, those are two separate aspects. I believe it's still in a growth period because of the growing realization among the likes of pension funds, let's say, and endowments, that, hey, you know what, return risk hedge funds as a group do better than the market, which is something I've said all along. And it also is partially diversified, not totally diversified, partially diversified with traditional assets like bonds and stocks. So more and more institutions are realizing that adding hedge funds, and then it was popularized by people such as Swenson, from the Yale Endowment, who wrote a book on it, and there's getting more institutional investment that is now putting some amount of investment into, and it doesn't take a lot given their size, into hedge funds. So there is growth. There's been a continuing growth of assets under management hedge funds. So as far as the ability for them to grow assets, that's probably easier in a sense because there's more demand.
Right.
But the ability to make money, that's a different story, because the more hedge funds you get into the game, the more difficult it becomes. And if, just for the same reason, people always make this comment about, are surprised when the majority of mutual fund managers lose money. Not lose money, but do worse than the index.
Right.
And it can't be any other way, because as a group, all the mutual fund managers are the index. They are the same thing. except one thing: they're buying and selling, and they've got cost of operation. So if they, as a group, they can't. It's mathematically certain that they're going to do worse than the index. And the same thing with hedge funds. If you get, hedge funds operating in the same market, as you get more and more hedge funds doing it, there's a limited amount of edge and profit that can be extracted from the market. And the more players that are going after that same bit of profit margin, the less there is for everybody. So, if you're a big fish in a pond with lots of small fish, you do very well. And you may still do okay when a few more big fish are put in. But once there's more big fish than small fish, the big fish are going to starve as well. So that's what I see as the potential problem. It's a natural equilibrium. So I think what's going to happen with hedge funds is the assets will continue to grow, but as they grow, it'll be the performance of hedge funds will probably, as a group, will probably deteriorate.
Right. Now, I may be completely wrong here, but did I read something about you starting your own fund here?
Yeah, no, that's true, but I'm not managing money. I'm just acting as an allocator. So I work as a portfolio consultant with ADM Investor Services, which launched a fund of managed accounts,
right.
Which is all futures and FX type traders or options on those. And I am a co-portfolio manager helping select managers and construct the portfolio.
Okay. All right. So I know we've already been going for over an hour. So at this point, I just want to ask a couple last kind of open-ended questions, and then we'll wrap things up. And I also want to remind everybody that we are going to give away 10 autographed copies of Jack's newest book, Hedge Fund Market Wizards. And I'm going to do that in the thread once we're done with the webinar. So kind of open-ended questions, Jack. When you look at everybody, and I'm sure a lot of traders contact you and you hear a lot of things, what similarities do you find that separate people that are struggling versus people that are successful? Are there any traits that you can say are really common? If someone out there today is listening and they're struggling as a trader, are there a few things that you could say, this is what you really need to focus on? Or is it not that easy?
Okay, yeah. So, kind of, what would be the advice for a trader, right? Who's particularly if they're struggling. So, one piece of advice I would have is you have to find you have to know what your edge is or what your method is. And if you can't answer that question, then I guess in a sense you really shouldn't be trading, because you don't really know what it is that should give you any reason to expect to come out ahead. And you have to kind of watch markets, experiment. It's not an overnight thing. You sort of have to develop it over time in consistency with whatever your natural tendencies are. So if you're the type of person who believes in fundamentals and skeptical of technical, then look at that and don't worry about the technical. Vice versa, if you believe in technicals. And reading is always a source of ideas. I would caution against reading something and just as a methodology and then saying, okay, here's a guy who made money trading this, I'm going to trade this. You can use the ideas and experiment with yourself, but don't try to copy somebody else's approach. So the first step is trying to develop a methodology. Now, once you've got that and feel you've got that, and you can trade nowadays. You don't actually have to risk your own money. There are ways you can trade simulated. You can also trade with real money, but start off with a very small amount of money. Trade much smaller while you're learning. And then one important piece of advice I would have is when you make mistakes, particularly when you make mistakes, take a snapshot of the chart and paste it into a Word doc and write some notes about what the mistake was and build up your own kind of trader's log on mistakes. And not only mistakes, but if you do follow your methodology and things work out, you can put that down as well. It's kind of, okay, here's what I was looking for, here's how it developed, here's what I did. And so you build up a compendium of your own notes and charts, illustration of things you did right and wrong. And that's something you can go back and review, and it helped reinforce doing the right thing and avoiding the wrong thing. So,
Right.
so I mean, I think that's what I would recommend.
And I think that one of the very first things that you said actually was that if there was one thing in common with all of these successful traders, is that they all have different ways of making money. There's a million ways. You said there was a million ways to make money in the market. They're just not that easy to find, right?
Right. Exactly.
Okay. Well, Jack, I really appreciate your time today. I consider it a great honor to be able to speak with you, and I know that the members were very excited to be able to ask all these questions and hear your responses today. When we're done, I'm going to go back to the site and give away those 10 books that I'll hopefully get from you in a few days. And maybe we can do it again sometime. Maybe you'll have another book come out. Do you anything in the works, or is it too soon?
Yeah, actually, well, I had a book. I actually was working on a book that I took to draft form before I did Hedge Fund Market Wizards, and I put it aside because I wanted to put out Hedge Fund Market Wizards first. And after I finished that, I went back and I finalized the draft, and that book actually has just been bought by Wiley, and they say that they'll shoot for a fall publication. It's a completely different type of book. The working title is Market Sense and Nonsense, but it basically is a compendium of everything I've observed in my years in the markets about all the things that people, when I say people, I mean not just traders, but academics, finance professors, and a lot of different things, that people just have raw things that people believe about the market that just ain't so.
Right. Well, that sounds
book, like I say, working titles, markets.
Right. That sounds like another fantastic book. I look forward to that. All of your books, they just have so much. You have to read them multiple times, to really absorb all the great information. And it's that kind of book that I really enjoy. I don't get a lot out of methodology books, with lots of charts. That just doesn't help me. The kind of book that helps me are the books that talk more about psychology and give me insight into how other traders, manage and think about risk. So I really want to thank you for writing all these fantastic books, and I look forward to all the books that you write in the future.
Well, thanks, Mike.
All right. Thank you, Jack. And thank everybody that was here today. Please go enjoy your weekend. I will post the recording of this webinar sometime tomorrow or perhaps Monday. And I hope everybody has a great weekend. Thanks, guys.